All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
Dude, I look forward to this conversation every week. It allows me to kind of look back and stand back. Sometimes I get involved in the day to day, but talking to you once a week allows me to step back. So thank you so much.
I love what we're doing. And I got to say, I've got so many of my friends, family, and really smart people reaching out to me during the week asking, what's going to happen this week? What is Michael seeing? What are you guys talking about this week? So I love what we're doing. This is for the week of December 16th. Let's get right into it. The big thing, obviously, CPI. What is it and what happened this week?
Yeah. So on Tuesday, we had the consumer price inflation CPI consumer price index, index for November. To kind of set the stage for folks, this is the number that peaked at 9.1%, I believe it was in June. It has been on a downward trajectory through October. Last reading was 7.7. Expectations were 7.3. I thought headline would come in a little lower at 7.2, and it actually came in at 7.1. So headline inflation is clearly trending in the right direction. What I have reminded people over and over and over again is we need to watch core inflation. So let's go back to the same time frames we were just talking about. June. In June, core CPI was 6%. Since then, headline inflation has now come down 2 full percentage points. Core inflation, still 6%. And as you will see in our next point when we talk about the Fed is telling everybody, look at core. So if you've been following our daily financial news, we've been following the weekly wrap-ups with Utah, most people should not be surprised. But, headline is coming down. The gap from headline to core is now only 1.1%. It used to be 3.1%. So all in all, headline is heading in the right direction. I believe headline continues to fall. Unfortunately, core inflation is sticky. It includes housing, wages, services, and it's more work to do. So CPI was generally speaking good. The trend is intact, but unfortunately, core is proving sticky. That's kind of the summary.
Interesting. I got to say, I really enjoyed this last week. $4. It was like $4 plus gas, and that was better than, reflecting on, it feels like 6 months ago, we were $6 plus. So very interesting.
Right. Yep,
okay.
Absolutely right.
Let's continue. Let's talk about the Fed meeting. What are your thoughts? What did you see this week? And maybe tell people what happened and give us your insight on it.
Yeah, so the Fed had their Fed meeting. Their Fed meeting was Tuesday, Wednesday. They came out yesterday and basically gave the market what they expected, 50 basis points. So now we're up to 3.7, or no, we're up to 4.25 to 4.5 on the Fed funds rate. It's what I've been calling for months. So we got what I've been expecting for months. And the interesting thing is, as we'll talk about near the end of this, is interest rates actually went down. Mortgage rates went down. So there's a lot of, we'll talk more about this in another section, but it's really wild to think about where the Fed funds, which is the shortest of short term overnight, and a 30-year mortgage goes down. I want to be very, very clear. The Fed funds rate today is 4.25. You can get a 10-year treasury at 3.44. So think about that inversion. Overnight is 4.25. 10 years is 3.44. That's not normal. So there's a lot of interesting things to talk about, which we will do in a minute. But back to the Fed. The 50 basis points was uninteresting. What was really interesting is the Fed released what's called their dot plot. It's basically their opinions about the future. So 19 Fed presidents voted, gave their opinion. And most interesting was, what did they think peak inflation or peak terminal rate was going to be? Again, today it's now 4.25 to 4.5. The average is over 5%. That's meaningful because just 2 months ago, Ty, it was 4.6. So in the matter of 2 months, they now think they have to go higher by 50 basis points. So again, higher, longer, slower. That's kind of what the Fed is telling us. And then they talked about GDP next year only growing 0.5%. For most folks, I got to tell you, if we have 0.5% GDP growth and we have 4% inflation, that is stagflation. By the letter of the law, that is stagflation. So again, 2023 from a macroeconomic perspective, not going to feel great. But I do think it's a year of bottoming or plateauing or whatever words you want to call it. And it gives us something to build on. But yeah, it's I don't think the Fed is painting a very pretty picture about next year.
Very interesting, folks. And stay till the very end of the video, because Michael and I are going to connect the dots. We're going to talk about the housing market, but as important, more important, we're going to talk about 2023. What are the opportunities? Is it going to be a great year for opportunity and for all your hopes and dreams? I know we've got a lot of real estate investors, a lot of real estate professionals that watch. Stay to the very end. Michael, let's continue. Let's talk about retail sales. What did you see this week on retail sale numbers?
Yeah, it's really weird. Last week we talked and I said, hey, you got to pay attention to retail sales. It sort of got lost, right? CPI, big number. Fed meeting, big number. Nobody was talking about retail sales. I would argue that retail sales was the most important number, and it came out on Thursday. Expectations for retail sales were negative 0.3.
Interesting.
They surprised to the downside, negative 0.6. So almost a double what was expectation to the downside. The reason this is important is because I've been warning people we're going to have an earnings recession. The consumer's not as strong as they look. And retail sales, I mean, think about it. This was retail sales for November. They were down negative 0.6. And I don't think the consumer is strong as they think. I think inflation is really, people are buying what they need, not buying what they want. And I think that's going to have a ripple effect across the economy, across retailers. And, I think really makes a recession probable, not only possible, but probable. So yeah, retail sales were an ugly number.
Very interesting. Let's transition. Let's talk about recession. What do you see with recession? Your thoughts on recession this week? Obviously tying back to retail sales.
Yeah.
Give us your thoughts going forward. And even too, maybe how recession and layoffs, something we didn't talk about pre-roll. How does that all tie together?
Yeah, I think they are. I think they will go hand in hand. I think there's a couple of things. I now believe that we will very likely have what's called a long and shallow recession, and I think that's important. Again, if the Fed is estimating 0.5% GDP growth for the year, you can really get to that a couple of different ways. And the way that I'm looking at it is Q1, Q2 are negative, and Q3 is flat, and then maybe some Q4 growth. Right? You could still, you could have 2 negative quarters and still get a positive year. And I think that's what's going to happen. I don't think this is an epic 3-4% GDP collapse. I think the job market specifically is stronger than that. But I do think layoffs will occur. And I think layoffs are going to occur, as I've said for months now, white collar layoffs. Mortgage brokers already happening. But next is Wall Street. I think Wall Street is going to have a bloodletting, right? I think they're going to have smaller bonuses. I think they're going to cut the bottom 10%. I think tech, we've already heard about Meta and Amazon and others. And oh, by the way, more is coming, in my opinion. I think these job layoffs are necessary. I think they will get lots of headlines, but I think for innovation, they're a net positive. And this is what I mean. Today, you have these top 5, top 10 tech companies basically competing for talent. It's an arms race. And what will happen when they start releasing people to the wild is they will join smaller companies. Now, they won't make as much money, but they'll be employed. So I think what will happen over the next year or so is we will have more headline job loss, but the weekly jobless claims won't be as bad because people will find jobs elsewhere. So I think it's going to be a shallow recession. I don't think unemployment spikes to something crazy like 7%. I think we see 5%, but I don't think we see 7%. So yeah, and again, I think recessions are a cleansing process, and I think we happen to work in a industry called real estate that had a lot of bad behavior. I think there were flippers doing dumb shit. I think there were um, apartment investors doing dumb shit. I think they were iBuyers burning money. I think Redfin, Zillow getting out. I think closed door, open door, whatever it's called, is done soon. And I think there was a lot of dumb shit happening in real estate because interest rates were basically zero. And some people will get hurt. But as you'll see at the end of this video, where there is great pain, there is great opportunity. So I'm excited, but we'll hold that on for the end.
Okay. You heard it here, folks. A lot going on. Shallow recession, very interesting term. We will continue to open that up and unpack it as we get into this week by week. So let's continue. Let's talk about mortgage rates. You mentioned about the 10-year earlier. Maybe go a little deeper in mortgage rates. What did you see there?
So first, let's kind of lay the story out. If you go back and watch your playlist on your channel or mine, you will see probably 6 or 8 weeks ago, I was like, dude, I don't know where these mortgage rates are going. How the hell do we get to 7.5 so quickly? And I think we actually had a show where I talked about 10% being possible, not probable, but possible, right? Because I just like 9 possible, but not probable. Today, as we sit here 6 short weeks later, not going to happen. 10's off the table, 9's off the table. I think even 8's off the table. And again, I get that because the Fed raised rates now to 4.25 to 4.5, and mortgage rates fell. In the last 24 hours, I've checked with 5 different mortgage brokers, and all of them have said with less than 0.5 point, you can get somewhere between 5.25 or 5.3, I think was the lowest, 5.3 and 5.99. Mortgage rates are sub 6, and mortgage rates sub 6 are important because we saw in other markets that above 6 things break, above 6 things start. And more importantly, Ty, I have learned that consumers have short-term memories. The first time we ran through 6%, everybody was saying, oh shit, I missed 4%. Now people are going to see 5.9, 5.7, 5.5 and go, damn, that's awesome. It's not 7.5. It is so funny how the consumer thinks. So I expect mortgage rates to fall. I actually am taking a wild guess, just a total wild guess, that the average 30-year mortgage rate, owner-occ, best credit, 20% down, is 5.99 sometime in Q1. That's a crazy call. I don't know anybody making that call, but I think it's there in Q1 of 2023. And I think that changes the market. I don't think it goes crazy, but I think first-time home buyers come back. I think FHA and VI buyers come back. I think luxury is still broken, but yeah, I think mortgage rates go down, and it's wild to think about. Right? Think about that. You could borrow money for 30 years at, let's call it 5.5, and in very short order, the Fed funds rate, which is an overnight rate, will be 5%. That is just wild to think about. So it's crazy.
Folks, pay attention. There's a lot of opportunity here. I want to get into, obviously, and I agree with you wholeheartedly. We've been talking about this. I believe, based on everything we've been talking about for several months, we're going to have a stable mortgage market going into the first quarter. So that obviously transitions us to the next topic, which is the housing market. What do you see there? And even as important as interest rates, do you believe sellers come back? Do we start to see a little bit more of a normal flow of inventory? What are your thoughts there in the housing market?
So again, I think the housing market, certainly in the first half of the year, is still bifurcated. What do I mean by that? I still think luxury, and luxury is 2x whatever your median is. If your median's 200, it's 400. Your median's 500, it's 1 million, right? So whatever your median is for your market times 2, that's what I'm calling luxury. I think that is still slow. I think that is still slow, mainly because the stock market is tanking. I think the stock market on Thursday was down like 800 points at some point or something. And I think there's a lot of people that are like, hey, I don't know what's going on. I'm not going to sign up for a $1 million purchase, for example. So I think luxury is slow. I think the move-up buyer is still slow. Because again, even if you're at 5.5, like I thought we might be in Q1 or 5.99 in Q1, that's still significantly above 3%. So I think supply is still rather limited because the move up buyer is not selling. So where is the opportunity? I think the opportunity is going to only exist in first time home buyer homes. So if you, and again, the beauty of what I talk about is I do what I'm saying. So if you go to my channel, One Rental at a Time, you will see that I closed on 2 properties in the last 7 weeks. The first one is already listed. 52 days after buying it, it is now listed. So we'll see what happens, and I'll document the wins and losses, but I am playing below the median. So what did I buy? First off, the median of my market called 400. So I bought heavy fixers for, one was 203 and one was 175. I'm going to list them both for around 300 grand. I think the first one went out at 309. I think the second will be 299. So I'm very below, and I'm doing a full remodel. So FHA, VA kind of stuff. So I think first time home buyers come back. I think it's a pain in the ass to live with mom and dad. I think first time home buyer programs are coming. Bank of America just released 0 down, 0 closing costs, 0 PMI, no minimum credit score. So I think lenders get very focused on first time homeowners. So as somebody who is living by what he says, I am going to go buy heavy fixers at a price point that I could do a full remodel and have a margin of safety and sell to that buyer. So that's what I'm doing. I think that's the spot of the housing market that unlocks, I think, in the first half of the year. I think luxury is still in trouble until the stock market bottoms. And I think move up, I think there's just years of move up buyers that just stay put. So that's what I'm thinking. But that's I don't know that I would have said that 6 months ago. But that's what I see now, because interest rates we started this wild range and interest rates are going down, I think. So yeah, I'm excited. I plan to do, I think my goals, Ty, are 12 next year.
I love it.
12. So you need to help me with that. We need to find some more stuff to work on.
I love it. I love it. So obviously a lot of opportunity. It's interesting too, because I personally, and you and I have talked about this, I personally have always felt, you want to work at the median or minus, basically under the median value. That's where most of the opportunity exists in most markets. So spot on. I love your thoughts there on the housing market. Let's finish strong. So folks, let's talk about 2023. And I said pre-roll, I really believe, you really believe it's a year of opportunity. And I said, hey, is 2023 the year of hopes and dreams? Let's talk about opportunity, Michael. What are your thoughts for 23?
Yeah, so I hope people hear this and they stay to the end. This is my 3rd down cycle, and they all feel terrible. I am actually so callous to it now that it actually feels awesome to me, but I'm broken. And I have to realize that most people aren't as broken as me. The reason I say it is awesome is because there's real pain out there. And there are people, as I said earlier, that did some dumb things. They are going to get penalized. They are going to feel pain. And where there is great pain, there is great opportunity. I have bought houses for less than replacement cost a lot of times. I have bought houses for less than land value. I have bought apartment buildings 0 down. I have bought apartment buildings directly from banks. None of that happened in 2021 or 2022. All of those things could happen in 2023. So what I would tell people, if you follow what Ty and I talk about, what we teach and mentor, is do the work, only do great deals, don't gamble, no skinny deals, no luxury this or that. Let's just be smart. 2023 is going to be about building wealth. And again, as I said earlier, I want to do 12 flips, but I also want to buy 3 seller finance deals that I will hold forever. So I'm adding to my portfolio and growing, and I'm just trying to live by example and have a lot of fun doing it. And I look forward to working with people like yourself to grow out a business in Fresno at the hub. I look forward to helping thousands of people realize what's possible. I have my number one goal is I want to send out 100 golden tickets next year. What is a golden ticket? This is for somebody that watches Ty or me and gets their first property. I want to send 100 of these, and I've already sent out 5. I want to send out 1,000 of these. These are deal cards after your first. So you can get 10, 15, 20 of these if you want. But this is why I do what I do. These are my number 1 and number 2 goals. It's not money. It's not flips. It's not this or that. I want to send out 100 of these and 1,000 of these. So let me know what you need to hear, what you want to have. Leave questions in Ty's Facebook post where he puts this, what you want to hear us talk about. We're going to help, and we're going to lead by example. We're going to do some deals together, and let's go. I'm excited.
I'm excited, man. I love it. Absolutely. The golden ticket. All of you out there with your first deal, make sure to reach out, message us, DM, Messenger, reach out, let us know. Michael, thank you for all that you do.
Yeah, one more thing. I think you have a Saturday pizza holiday party or something that I'm going to pop in for. Do we want to put that on blast?
Yeah, for sure. So we will be in Walnut Creek, California, December 17th, Walnut Creek, California. Would love, message me, send us a DM, send me a message. We'll get it. It's going to be at Skipolini's Pizza on Saturday, December 17th, around, I think, a 5 p.m. start. So would love to see all of you out there. Michael's going to be there. Super excited.
4 books. I'm bringing 2 books of 2 hard copies of each. I'll sign, autograph. I'll have Ty do some kind of giveaway or trivia contest or something. So be it, what was the name of the place again? Skipolini's?
Skipolini's in Walnut Creek, 5 p.m. Saturday, December 17th. Michael, thank you for remembering to promote that. Thank you for all that you do. Folks, 2023 is going to be a year of opportunity for a lot of you, hopes and dreams. This is going to be a great market. How? By being a solution. There's going to be a lot of pain out there, a lot of problems, but when we show up as a solution, that's how you have a lot of success in this business. Also, if you're in Fresno, California, if you are a realtor, if you just passed your license, if you're looking to get into the business and you're in Fresno or nearby Clovis, we've got a free office for you. We've got free coaching support for you. Michael and I are looking to build a strong powerhouse team in the Fresno greater market. So would love to connect. Please message me for that. Michael, thank you for all that you do. Have a great weekend. I'll see you Saturday.
Got it. Take care.
Love it.